when you go and you change your focus, you still have to make sure that you don't let the other ones go. And so we had to put different systems and procedures and processes into place.
So you found that the profits at one went down while the new one, two, was doing just fine.
Correct, yeah.
Okay.
You're listening to Business Lunch with Roland Frasier. This is your seat at the table.
Hey everybody, this is Roland Frasier with Business Lunch. My guest here today is Dan Handford from PassiveInvesting.com. Thank you for being here today, Dan.
Thank you, Roland, for having me.
Where did you come in from?
Columbia, South Carolina.
Columbia, South Carolina, and we are in beautiful Laguna Beach with the amazing view of the ocean, and not able to be seen
just behind those doors
because we have to have the lighting correct. So, will you just kind of tell everybody that's watching / listening a little bit about you and kind of what you're doing? I know you've got an 8-figure business you've created, and we're going to talk about kind of how that all evolved, but give them a brief synopsis of kind of where you're at now, and then we'll dive into the past.
Sure. So right now, you mentioned PassiveInvesting.com, and that's our real estate investing, group that we started. This is actually our second year into that business.
Okay.
And
that's only 2 years old.
It's only 2 years old.
Okay.
So, but we wouldn't have been able to do as much as we have done with that business if it wasn't for the past.
Okay.
So we're going to dive into that, I'm sure. But,
okay.
With what we've done right now with PassiveInvesting.com, we basically acquire large apartment complexes, 100 units or more, minimum $10 million in acquisition, by using private investor funds.
Okay.
So, normally you have like a REIT or a hedge fund that might go in and acquire these large complexes,
right,
because an individual a lot of times can't just write that check for that. Now, there are some wealthy families that do it, but
sure,
a lot of times it's a REIT or a hedge fund that does it.
Okay.
Well, we've built a company called PassiveInvesting.com that does what's called a multifamily syndication, where we actually pool private investors' funds. Usually there's a minimum investment in there of like $50,000, and we'll have 35 investors on the low end, upwards to about 100 investors in each one of our assets that we acquire. And so that's what we've been building over the last year and a half, and kind of growing that company. But it all started from the beginning and from the past.
Okay, cool. So, well, let's talk about that then, because I love diving into the beginnings. And I think that you said the beginnings, like your first entrepreneurial thing was with the college textbook.
Well, it wasn't with a college textbook. It was with a college spine model.
Okay. Was that the first thing?
I would say that was the first big thing, because I'd had a couple other, like growing up in high school, I'd do, pressure cleaning and yard work and, going door to door selling Cutco knives. So I've always kind of had that entrepreneurial itch.
Okay.
But I never really had a true success or a business until that business.
Okay. All right.
And it was actually created out of a problem that I saw that was there and needed to
Which
solve.
Which is the ultimate thing. That's the frustrating thing, though, is people say, when I was coming along and wanting to be entrepreneurial, everybody's like, well, find a need and fill it. I'm like, oh, but I don't know a need that exists that hadn't been filled. But there are a ton of them.
There's
right?
a lot of them.
And so if you're looking for the need and frustrated because you haven't found it, it will appear if you are mindful of looking for it.
It's all about being cognizant of your surroundings, and hearing and listening to people.
Yeah.
Because that's how this one happened.
Okay, so tell us the story.
So my background is in chiropractic, and when I first went into chiropractic college, one of the things that all these students needed was a spine model.
And what is that?
A spine model. So, you have your vertebrae in your spine, you go to the chiropractor and they adjust you and they're moving those bones. Well, they have to know where those bones are in your body to be able to adjust them and to be able to move those bones.
So like the skeleton you see in a doctor's office, only just the spine?
Just the spine
so
portion.
So that they could kind of...
Exactly.
Okay,
and they can
great.
put it on the table and position it and various things like that.
Okay, cool. So everybody has to have one.
Everybody has to have one.
All right.
And of course, the bookstore is going to sell them, right? Because they sell everything and mark it up 10
times. Because they're very
nice.
It's just out there to give those bookstores.
They're for a profit, for sure. And with the funny thing about bookstores and universities is that they usually sub those out to a different company so that the students can't complain to the college.
Okay.
And they just make a revenue share off of it.
That's pretty funny. Okay.
So there's usually one company that owns 15 or 20 different bookstores in a particular region, or even there's even one that has more than that. But I digress. But they're usually overpriced because it's there as a convenience to the student.
Sure.
So I remember when our first, quarter of chiropractic college, all the students complaining about this spine model because we're poor, broke college students that we needed to buy a spine model, and they were selling it for $190, and it really wasn't like the highest quality. Like you can get a really good quality one for $190, but it's just like PVC plastic.
Okay.
And so I went to the bookstore, and because I heard their problem, right, of the $190 spine model that nobody wanted to spend money on. And so I went to the bookstore, and I was like, I wonder if I can figure out who makes this thing. And so I ended up going online and doing some research and finding a distributor of that spine model. And they were I called them up and I said, hey, I want to be able to sell 40 of these things. How much money would it cost me to buy these things? And they said, well, including the shipping, it would be $65.
It's a pretty big discount off 190.
It's a phenomenal discount, right? And so for $65, I told them, I said, oh, great. I'll go ahead and get some orders in place. But I didn't want to have any IOUs or anything like that, because these are college students, right? Yeah. So I was smart,
notoriously
ahead of time.
dependable crowd.
Exactly. And so I made sure that I had them pay up front. So I had PayPal links, and so I could accept credit cards, and they could give me a check or cash, but there was no IOUs.
Okay.
So I went in front of each one of the student body classes or whatever and presented this offering of the spine model. And I was just thinking, I'll make $5 on it. And of course, I didn't want to sell it for $70, so I knocked 5 cents off, and it was $69.95, right?
$69.95.
$69.95.
And you're paying
$65.
$65.
And that included shipping.
So you're making $5.
Yeah, $5, and all I'm doing is brokering it,
right.
Really.
Okay.
And so I went around the classrooms. The first week, I sold 80 spines with cash up front.
Way more than you thought.
Way more than I thought. And of course,
this is at one college?
This is just one college.
Wow. Okay.
Yeah. And thankfully, all the teachers were fine with me getting in front of the classrooms and talking,
That's pretty cool.
and selling from
and
the stage.
And they were actually
if you
probably
will.
happy because they wanted to help the.
Exactly.
They don't have an interest in the bookstore.
They don't have
right?
any interest because it's some other company.
And the college isn't saying you need to do that. So yeah, cool.
So ended up
$400.
Well, so it ended up that because I had sold 80 of them. I actually went straight to the manufacturer and I said, hey, I had this order of 80 of these spine models.
So you had the deal with the distributor.
I was working with the distributor.
Okay, great.
Who now to this day is still our biggest competitor, which is interesting. But so we went to the
you're still selling that stuff?
We're still selling
That's
it.
so cool.
It's actually our number one selling product. We sell 300 or 400 a month right now.
How long ago did you do this?
That was 12 years ago.
So 12 years ago, you saw the need and filled it, and it's still working out.
It's a 7-figure business that continues to run.
That's awesome.
And it's passive, and that's great.
Nice.
And it's funny because I've considered selling it.
Yeah.
But I feel like there's a part of it that's I'm attached to it. And I don't want to give it up. And I also kind of think it's kind of a safety blanket, because if for some reason something does happen to my other businesses, I could always fall back on it and continue to do. Is it doing as well as it did when I was running it from day to day? No, but I don't have to do anything with it.
What kind of profit, if you can say, does it make?
About 20%.
About 20%.
About 20%.
Okay.
So at the end of the day, and I'm doing nothing. I say nothing. Maybe an hour a month. I might be sitting down with my corporate team or something like that, but that's it.
Nice. Cool.
So it's not bad. But so I went to the manufacturer, kind of going back, and I actually the lady told me, she said, well, if you can sell 80 of those things, how many times a year could you do that? And I said, well, there's an incoming body of students every 3 months. It was a quarter system.
Quarterly. Yes.
Yeah,
exactly.
quarterly. And so I'm 4 times a year. And she's like, oh, well, I'll set you up on our highest tier discount, and you can get 40% off the spine model and all the rest of our products. And so I said, well, what is that going to get me? She's like, it's $42.48.
Nice.
And I said, well, does that include the shipping? And she says, no, but I'm sure I can work that out. So she actually she actually worked it out. So I got it for $42.48, and it included the shipping.
So now you're making $20 plus per unit, right?
Exactly.
Nice.
Exactly.
All in.
And so I was getting really excited then, so
$1,600, yeah.
And the funny thing is that I lived in a townhome at the time, little 2-story townhome, about 1,200 square feet, and I didn't have the place for a semi truck to come pull in and turn around and drop off a bunch of pallets. It ended up being 4 pallets. They put 20 spines on each pallet.
Yeah.
And they asked me, where should we ship it? And I was like, just ship it to the school. So, because I
attention me.
Yeah. So I had them ship it to the school, and then I called the shipping, dock or whatever they have there. There's a shipping director or materials director or whatever.
Right.
And
Physical
I said,
plant,
just so you know, I have something being shipped there. When it gets there, just give me a call and I'll pick it up.
You didn't tell him how big it was.
I didn't tell him how big it was. So I get this phone call when it arrives, and he's like, you have 4 pallets that's blocking our dock right now. And I was like, don't worry about it. So I text messaged everybody. So I had them on a group text.
Pick them up quick.
Come pick them up. Within an hour, they were all gone.
That's awesome.
It was the funniest thing.
That's hilarious.
But I did get called into the student director's office and was told I couldn't do that.
Right.
After I had done it the second time. So the first time I was fine. But the second time, they're like, you got to stop. Because I actually 2 weeks later sold another 40 spines.
Did you really? Nice.
I did.
Okay.
So I just continued to sell them and stuff like that. And
was that into the same, just the one college still?
Yes, it's all just the one college.
That's amazing.
So, but what I did is prior to going into chiropractic, I had a business where I was doing web design, web hosting, networking, that kind of thing, and into the kind of the technology space. And so I took those skills and I said, I'm going to create a platform for me to be able to sell all these products, because it opened me up to their entire catalog of over 2,000 products.
Right.
And so I actually at that time started an eBay store and just started selling them on eBay. And they started selling. I was like, well, maybe I'll, design a website and have them sell on a website.
And this is like medically model-y kinds of things?
It's like it's skeletons, brains, hearts. It's called Shop Anatomical. So it still exists.
Your shop is?
Yes, it's called shopanatomical.com.
So was there any challenge with their other distributors and sellers with you going online and selling at discounted prices on eBay?
There was, but I knew what the problem was with their presentation, and so I figured out what their problem was when they were selling. So I took a lot of the products that were online because with Anatomical,
they had a web store as well, the manufacturer?
Okay. They both did. And actually, some of these images got stolen from me because I paid an actual product photographer to take because with these anatomy models, a lot of people will call you up and they'll say, hey, do you have the amygdala in the brain? And you're like, well, you can't tell online because the pictures are terrible,
Right.
So I took the extra painstaking step of making sure we had really high quality photos, and I would not put any product on our site unless we had really high quality photos.
Okay.
Like you could really zoom in, paid a lot of money in bandwidth and all this kind of stuff because it took so long to download some of these things. But I knew it would be important for these type of products. And so that was one thing that I did to kind of stand out, was making sure that people could actually see it.
How did you deal with the people that were stealing your images?
Well, that was a lesson learned because the graphic person actually owned the rights. And so I now, moving forward, know that before I hire somebody, I want to make sure I own the rights.
That is so
they sold them.
They
sold them to have somebody else.
We had a client that when I practiced law that was a graphic design agency, and they designed all of the logos for a very famous, well-known golf company. And but they retained the rights. And when the company sold to a giant firm for a lot of money, I think it was hundreds of millions of dollars, they said, well, you don't have the rights to that, so you can't get that. And when they were doing their due diligence, they said, well, we are not buying the company if we don't buy the rights. So it was holding up a giant deal.
Wow.
And they came back and they ended up suing our client that was the graphic designer. And we were able to settle the case, I think, the day before Customs was going to destroy all of the incoming golf clubs that they had with my client's logo on them. And they were like, we have to settle this. So what it taught me was what you learned also. And fortunately, I learned it on the profitable side because I was the bottom dwelling attorney that was making money off of it. But I learned that you've got to have those rights. You can't. And those graphic designer deals set them up, most of them, that they own the rights and they're only licensing them to you. And so you've paid the money and you get to use them all you want, but they own the rights. So that's a really I want that to sink into everybody that's watching / listening, right?
I mean, that could save you millions, literally millions. I mean,
seriously,
we actually had and after that all happened, we had an anatomy illustrator, a medical illustrator, actually design us a whole line of charts. And that was one of the first things I negotiated.
I'm owning the rights.
Some of them didn't want to do it for us because they were like, well, I want to retain the rights.
Yeah, cool. Then I'm not going to pay you.
Move on to the next person.
Yeah, exactly.
So we ended up finding somebody to do them, and she's done a really good job for us. And there's a lot of profit in charts because you pay the graphic designer, which is the upfront expense, but then the charts cost you like 50 cents, and you're selling them for like 20.
Right.
So there's a lot of profit in them, but obviously when you're shipping a chart, there's also shipping and stuff like that.
Right. So that's kind of cool. So what did you do with that? You just basically said, okay, I got screwed on that, or
there wasn't anything I could do. Okay. So I mean,
were they licensing them out to somebody else after they had done them for you?
Yes, they weren't necessarily licensed. I guess they were licensed, but they would just pay us $500, we'll give you access to all the images.
But they still own the right, so they could do it again and again and again.
Do it again and again. So I mean, it was one of those things. It was definitely a lesson learned. But one of the things that I knew that I was doing right was trying to look to the customer to see what were they wanting to be able to buy. Because we started selling, $20,000, $30,000, $40,000 a month, and then when we really launched our web store online, we put a lot of money behind the Google pay-per-click ads, and that's where we drive a lot of our traffic from. Because Facebook retargeting and Facebook ads, they just really don't work for this kind of business because they're like, I want a skeleton model. Like you can't like target biology teachers because they're not like at that moment looking for a spine
traffic,
model.
right?
Exactly.
Yeah, search intent.
So we spent a lot of money on that. But
so now, did it get how did you're in school doing this, right? How big did it get while you were still in school? How long is chiropractic school?
4 years.
4 years. So was this at first year because you were?
This was the
you had to
first
buy it,
year,
right?
yes.
So what was happening by year 4? And were you thinking I'm not going to practice chiropractic?
It definitely had crossed my mind, but it did allow us to open up the chiropractic business debt free. So we didn't have any debt when we opened it up or anything. So
what kind of volume were you at last year? Not last year of school.
Yeah, we were over 7 figures. I mean,
that's amazing. So you built $1 million business while in school out of just, hey, maybe we shouldn't be charged so much for this.
And it's funny because I, in between classes, I wouldn't like go in the hallways and talk. I mean, I would actually try to get there really early in the morning and park my SUV. And I bought a laptop stand for my SUV. And so I would, in between classes,
did you sell them out of your SUV?
Oh, of course,
That's
absolutely.
Awesome.
But I would drive the SUV as close to the building as possible.
Right.
And then it didn't matter if it was raining, snow, whatever. I would drive. I would get out of class, go straight to my SUV, crank the car up, and have the laptop on there, and I'd be responding to customer calls, and like, people would call up and they'd be like, hey, I wanted to see if I can get, a discount, or I want to get this fee waived or whatever. Like, let me put you on hold and talk to my manager. I'd put him on hold, and then of course, when I was a year into chiropractic college, I got married to my wife, who's still my wife now.
Nice.
And
Danae?
Danae, yep. Yeah, we have stories all over the place of, customers calling in and complaining and, let me get my manager on the line, and my wife would jump on the line.
That's
and
so great.
that kind of stuff. And then what had happened, towards the end is that we had a manufacturer that was from Germany, but they had a facility there in Georgia where I was located in Atlanta, Georgia.
That was convenient.
It was very convenient.
So could you just pick up from there?
We could.
Nice.
And so here was the difference is that most of our products are drop shipped. But if you drop ship from some companies, they charge you a premium. So instead of 40% off, you might get only 30% off.
Right.
So with this company, I basically said, well, once a week, I'm going to drive down there. At first, it was like every other week. Every other week, I'm going to drive down there. And I'm going to send you my orders. I just want you to hold them for me. Just put them off to the side, and I'll come pick them up.
Right.
Gave me an extra 10%.
Nice.
Well, then it went to like once a week, and then it was twice a week, and then I'd have to like go down there, rent a U-Haul, go to the place, load all my stuff up, and just drive it over to the FedEx place just to save that 10%.
Yeah.
But it was 10% of thousands of dollars.
A lot of money, yeah.
So to me, it was totally worth it. And so finally, after about a year and a half of doing that, right before we left, and we moved to Columbia, South Carolina, where I set up my practice, I got a call from the vice president of that company, and he basically said, all right, let's talk here, because I'm tired of you coming down to our offices. And he said, how about instead of charging you 10%, I'll just charge you 4%. And I was like, done.
Yeah.
4% is fine.
I can put the cost on that. That's what it cost me to have the person driving down there.
Exactly.
Yeah, no problem.
So, we have a lot of those kind of stories. And then we had one story of a hospital in Texas that actually ordered a 10 times life-size heart model. It was like huge. And it was one of those models where my wife, when I was designing the site, she's like, don't put that on there because no one's going to ever buy that. I'm
Long
like,
tail.
You never know.
Yeah.
It's like a $6,000 model.
Right.
And so
if
sure
you're a
Enough,
Starbucks coffee espresso machine, right? Nobody buys it, but when they do, the profit's good.
It's just that 10% that buy, or that 1%. That's okay.
That's right.
But we had to. It takes like 8 weeks to order those larger models from Germany, and if you in transit it gets damaged, it's another 8 weeks to get it in, get a new one in. And it's a $6,000 model. And so there was a heart lab or a heart hospital opening up in Texas, and they wanted this for their lobby. And so we didn't want to freight it from Georgia to there. So we just basically said, all right, we're going to hop in the car in the SUV, and we're going to drive it over there.
Oh, wow.
So my wife and I just drove 15 hours. I think it was actually Dallas or Houston or something like that. We drove for 15 hours, dropped it off. They put us up in a hotel
Nice.
and, all that kind of stuff, and delivered it. And so we have a lot of cool stories about that business. And that's probably,
It's really
again,
cool.
one of the reasons why we haven't gotten rid of it yet.
It's too much fun.
It is.
Yeah.
Well, and with online companies, you're not going to get the premium you're going to want for it.
Right.
Because the multiples aren't there on those online businesses.
Right.
So
I will give you $100 cash for it right now. I have $100 cash.
I bet you would.
Cool. Okay, so now you are doing 7 figures. You move and open your chiropractic practice. Was there a decision? Do I want to do the chiropractic thing or just do this?
There was, but all along the way, the doors have continued to open up for me to stay in the chiropractic space. And so we decided that that's what I wanted to do.
Okay.
Because we also looked at it and said, yes, I was working full time in the shop anatomical business, but I could also hire somebody to do that. because it was to a point now where it was really just handling the customer service calls, and where's my tracking number, what about this billing issue. So it wasn't really anything that was like really high level that I had to do, and those small tasks I could just do in between seeing patients.
Okay.
And so we actually hired somebody to actually run that, and so they've been running it and managing it, and I don't have to mess with it. And so I started the chiropractic business. Well, going into the chiropractic business, there's this thing that is, you think that you're owning your own business, but really in chiropractic you're trading time for dollars, because there's only so many people you can adjust in a day.
Same thing with a law firm. I had the same exact
thing,
right? Yeah.
So it's always like those cool professions, but then when you start to get into it, you're like, wait a minute,
pretty limiting.
It's limiting. Like there's
you can only add
amount.
other people like you that work under you, and then you just have a scale, issue.
And that's what I ended up doing. About 2 or 3 years into it, I hired on my first associate doctor to come work for us.
Right.
And he worked in the business, and then I got to work on, on the business instead of in it as much.
Yeah.
And eventually we decided to integrate into the medical space. We had what's called an MD-DC clinic.
Okay.
And from there,
I got to know, because I'm an initial guy. What does it stand for?
MD, medical doctor, and then the DC is the doctor of chiropractic.
Okay.
So kind of a mixing clinic of a MD-DC.
Okay. So you had another medical doctor that you brought in as a partner, or?
No, it was just as an employee.
Okay.
So
nice.
I still own all of it 100%. So I've done that strategically.
You're like the graphics company. You're like, I own it and you work.
I'm telling you. So I have I have 2 people. Well, actually, I really only have 1 person that has phantom equity.
Okay.
And that's it.
All right. Nice.
And it's a very small amount, but it's an amount that allows me to do what I want to do.
Will you, since you mentioned it, will you give a brief, just tell people what phantom equity means?
Sure. So instead of giving up your ownership of your company and control of your company for a variety of reasons, not just control, but also tax reasons and things like that for the person who has the equity, and you also protect yourself from downside of that person leaving and still owning your business. You basically give them fake or phantom equity into your business, and they basically are sharing in all the profits. And
it's like they owned it, but they don't actually own it, basically. And
And
if it sells, I'm assuming they get some sort of ride along, right? So that if they own like 3%, they get 3% of the purchase price.
Yeah,
right?
and a lot of times companies will do that in the beginning stages, and then when they actually exit it, that's when they get their nice windfalls.
Exactly.
Is when they do that.
Nice.
So, and it's funny is that this person and I have no agreement written down anywhere for it.
Yeah.
But he knows me, and I know him, and we've done really well, and it's just worked out that way.
So when I came into ID Incubator was the company that owned Digital Marketer and all that. In 2013, we did our deal, and my partners Ryan Dice and Perry Belcher told me after the deal they forgot that Richard Lindner had phantom equity that I didn't know about. So they're like, "Oh, sorry, but I know you just did this, and this was a 7-figure-ish, deal, or it was 7-figure plus, right? Deal." So then they had to say, well, there's a piece of the company, fairly significant piece of the company that we have this other owner on. We that dilutes all of us, and there was nothing in writing about it, and they'd had it since the beginning. So I think that was maybe 4 years in that they'd had it, and so I think 2 years later we finally got around to getting it documented. But same thing. But Richard knew, we're all good guys and we're going to make it happen. I wouldn't ever recommend that anybody do that. But and if you do that, be the person that's granting the phantom equity, not the person that's not. But it is a really great way to do things. So yeah, that's to me, that's really cool, because I think agreements, as a recovering attorney, agreements are only as good as the people that make them. So it's really cool that,
once you get sued a few times, you realize how well these agreements are not written.
No
and there's
kidding.
no way you can find every little hole.
Yeah.
Because if you have a good attorney, or on the opposing side, they're gonna find a hole somewhere.
Exactly. Yeah.
So.
Okay. Well, back to the thing. So you have the business is growing. You got the phantom equity person. You had hired on people, so that business is growing, and the other business, which is Just Anatomical, is that what?
Shop Anatomical.
Shop Anatomical. Shop Anatomical is growing. So how do you go forward from here?
So when we started to hire on the medical side, I realized very quickly that I really I had the passion of being able to kind of scale and grow, because I'm a very visionistic or visionary type person, and I like to, I like growth and I like scaling, and when I don't see that, I get bored.
A little frustrated, yeah.
I get frustrated.
Yeah.
And so what I had decided to do was I set a goal to, in 24 months, I wanted to scale from 1 clinic to 5 clinics. And so I brought all my team together. It was like 12 at the time, and we had a 5,000 square foot office that we were, running the practice out of. We had the medical team there. We had the chiropractic team. We actually had some physical therapy going on, and we decided to scale. And of course, a lot of them I could tell were kind of rolling their eyes, like, yeah, right, we're not going to be able to scale that quickly, and grow that fast. And I knew that we needed to make some changes, but I didn't know what those were going to be until we scaled to the next clinic.
Okay. And were you renting space in the building?
All of ours are rented.
Okay, cool.
Yeah.
Okay, go ahead.
So, and I did it on purpose because I didn't know how well these were going to run. So
yeah. Well, plus it's pretty expensive to throw all that stuff together.
it does.
Okay, cool.
And so we probably, I think each clinic we were able to open for about probably $125,000 a piece. So it wasn't like an extreme expense, but there was definitely some money that had to be outlaid to be able to put in the X-rays and the fluoro machines and the outfitting of the office and stuff like that. But we scaled to the second clinic, and the second clinic was the one we learned the most lessons on.
Okay.
Because in that second clinic,
so it's the one that just took off and did perfectly. So there was no
in the beginning, the second one did.
Yeah.
And so the problem really wasn't the second clinic.
Okay.
It was the fact that we took our core team from the first clinic
To open the second.
to open up the second one.
Ah, okay.
Because we were like, well, we don't want to have to lay out too much more money, and so we
Right.
don't want to hire too many
So you
people.
split the team.
And so we split the team.
Yeah.
And so the second clinic was profitable in the second month. I mean, it was doing phenomenal. And then at the time, our management style was looking at the finances quarterly.
Yeah.
Obviously, we're looking at the bank accounts and stuff like that, but like the
Trailing
the
indicator.
trailing stuff was not until like the quarterlies.
Right.
And so,
So things can go wrong for 3 months before you
it
really
went,
know.
and it did, man.
Yeah.
We opened it, I think, like at the end of the first quarter of that year, and then by the end of the second quarter, we looked to pull the reports, and we're like, oh my goodness, we got to do something.
Right.
And so that taught me a lesson that when you go and you change your focus, you still have to make sure that you don't let the other ones go. And so we had to put different systems and procedures and processes into place.
So you found that the profits at one went down while the new one, two, was doing just fine.
Correct. Yeah.
Okay.
And, we didn't actually, I wouldn't say I guess it depends on how you look. I'd say we didn't lose money, but
Sure.
technically you did.
You left money on the table.
Yeah, you left it on the table.
Yeah.
And so we had to, instead of looking at them quarterly, we started looking at them monthly. Well, now because we have 5 clinics, we're looking at them every week.
Yeah, which
And
ultimately I think makes the most sense.
Yes,
right?
yeah. So every week I get financial reports, even to this day on Monday mornings, that I call my Monday morning financial reports. Usually takes me about 30 minutes to review them, and then I have a corporate meeting team with my team about once a month.
Do you have dashboards as well? Anything like that you look at daily?
No, we don't have any of those.
Okay.
Obviously, we're looking at various KPIs on those
Yeah.
on those financial reports and stuff like that. We don't have like a software or anything. I have a staff accountant that sends me numbers, and then I have a marketing department that sends me numbers on how many new patients we had in, how many calls we had, how many books.
And those are weekly?
percentages. Those are weekly.
Okay, cool.
Yeah.
So that's a really good thing for us to talk about for a minute is the scaling. So you had one thing that was working profitable, and you said, I should probably have
Let's just duplicate
4
it.
more, right? Yeah. And you did that. And one lesson that you took away was the core team, don't take that to the new one, but then you still have to find those people, and you only have the core team that you've got. So how did you solve that as you went into 3, 4, and 5?
I had those core team members hire the next core team members.
You did. Okay. So they're interviewing and hiring.
They're interviewing and hiring.
How did that work?
It worked out very well. I
Yeah.
mean, obviously, we went through a couple of them here and there and stuff like that, but for the most part, it worked out really well.
It's really smart. I like that.
But really, when we went to that second clinic, I never really had a hierarchy or a chain of command other than just like, I am it. And so you guys got a problem, come to me. But once we started to scale, that just was not going to work because I didn't have time to be able to answer everybody's problems or issues or questions. And so I started to actually, put a system in place where, all right, I'm the CEO. I'm going to have my COO, and I have my, my person who's over our director of billing or whatever, and our compliance officer, and then everybody else reported to them instead. We had office managers now in each one of the locations, and so all these staff that work in the office report to the office managers, and the office managers now report. So there was this nice chain of command in place, and it was a hard transition at first because I remember the meeting to this day of me basically saying, "Don't call me anymore."
Right.
And it wasn't like trying to be mean. It was just like, if we're going to scale, like
You can't call me.
I can't.
Yeah.
And people would still call me. And I told them, I said, if you call me, I'll know your answer to your question. But I'm going to tell you, did you ask this person yet? Did you ask that person yet? And if you haven't, then you need to go talk to them. And if you have talked to them and they haven't gotten you the answer yet, then I'll go talk to them.
Right.
Right. And figure it out. And so it was definitely a transition from
How
that
long
period.
did it take?
A year.
A year. Yeah, that's about right. Yeah.
And that's how long it took us to open up the third clinic.
Oh, it is.
It was
Okay.
12 months.
Okay.
But the next 6 months, we opened up the last 3.
Okay.
So we actually opened them up
So you
in
have
18
6.
months.
6 total.
No, there's only 5. So
5. Okay, so last 2.
Yeah.
Okay.
Well, we only had the 2 clinics. And we opened up the third, the last 3 on after that first year.
Okay, I see. Okay, got it.
So, but that was the reason why it took us a year is because of all those lessons that we had to learn about the core team and the management and the hierarchy and even kind of honing in some of the marketing now that we had 2 clinics. And then we also put together a centralized call center for all of our we had administrative staff,
setting appointments and all that.
Setting appointments, medical records, billing, authorizations, all that kind of stuff. All in the same building. Okay. So what we decided is after we opened up the second clinic, I realized really quickly that I could not scale it with all of it combined. The chiropractic, the physical therapy, and the medical. It just was not going to be possible without maybe bringing in some outside equity.
Sure.
And I didn't want to do that.
Right.
And so what I looked at was I said, what in the business has the highest profit? And what could we scale? And that was the medical side.
Okay.
And so we actually decided...
Medical as opposed to the chiropractic?
Correct.
Okay.
So we actually decided to completely cut out the chiropractic at all, completely. Okay. So we removed the chiropractic, we removed the physical therapy. And a lot of people were asking me, well, why would you do that? Aren't you a chiropractor? And I'm like, yes, but chiropractors, in order for me to scale my business, I needed to team up with them because chiropractors don't refer to other chiropractors. They only refer to outside chiropractors.
Makes sense. They're afraid of losing the business.
Yeah, they're afraid to lose the business. It's totally different in medicine. Okay. Medicine, they'll refer to a cardiologist or
based
an orthopedist.
On specialty.
It's based on specialty. Right. Chiropractic, it's different.
Is that because chiropractors can cure everything?
That's right.
Yeah,
that's
right. They're basically the god doctor.
That's right. That's right. But with the chiropractors, we actually now build a referral network with them so that because the type of medicine that we practice is what's called non-surgical orthopedics and sports medicine. Okay. So we do a lot of regenerative medicine, prolotherapy, PRP, stem cell. Okay. And so the best type of patient that we can help is someone who's already failed at chiropractic or physical therapy. And so now we're creating these two-way referral networks where we can get patients in and we can bring it back and forth. And it actually worked out really well. It was scary, but I was like, I knew the moment I thought of it, I was like, that's what we have to do. Okay. And we cut it out, and so we were able to reduce the square footage.
The chiropractic
completely. So the second clinic was about 4,000 square feet, a little over 4,000 square feet. Okay. The rest of the clinics were 2,500 square feet.
Wow. Okay.
So it's a pretty significant drop.
And what kind of medical stuff?
So with as far as the treatments, we do a lot of knee treatments. We do a lot of back treatments, spinal treatments. The types of physician that we have is a physical medicine and rehabilitation physician. So it
wasn't like internal medicine and heart transplants and stuff like that. Not that you would do that in a 2,500 square foot. I mean, ideally, but just so people know, it was directly related to the chiropractic stuff. Just on the would you say it's like an elevation, like a step up from the things that would be treated through chiropractic?
Absolutely. So it's something that if for some reason... No, it was all non-surgical.
Non-surgical, okay.
Yeah, so we did most of what we do is injection based.
Okay.
But it's instead of trying to always just inject a steroid or some form of chemical, we're a lot of times taking the patient's own bodily fluids like their blood or stem cells and re-injecting them back into the body into the tissue that needs to be healed and repaired.
Nice. Okay.
And so a lot of our services are cash based. So we have a whole system in place there for the whole sales process, which could be a whole other podcast.
Okay. So so you scaled and it probably should be. So you scaled up the medical side of things, you got rid of the chiropractic, and that allowed you to have many more referrals, right?
Correct.
And so how did that go?
And we scaled faster. So instead of taking another year,
and just so I understand too, in one of the 5 clinics, you have a call center that's handling all the administrative stuff like that. Okay, cool.
So because we had the 5,000 square foot office from the main office, and we were kicking out the chiropractic and the physical therapy, we used all that space for administrative staff.
Okay.
And so we have call center with cubicles, and they're answering phone calls all day long, and we do a lot of radio and newspaper and TV advertising and online, and so we get a lot of leads coming into that training center or that center. I call it my training center because I do a lot of phone training with them to make sure that they're answering the calls properly and handling them properly and things like that.
Nice.
Because you can definitely see the numbers drop when they start to get away from the residual training.
Right.
So there's a whole lot of lessons from that piece too. But
so
then we were able to scale to the next 3 clinics within 6 months, 3 in 6 months instead of 1 in 1 year.
Okay.
And it was because of all the lessons that we learned and the things that we put into place.
So how many do you have now?
5.
Okay.
I have 5 total.
And why? So why not expand more than 5?
Oh, I get asked that question quite often. I would say I have a mind block on distance.
Okay.
Because our main office is in Columbia, South Carolina, and then within each one of the clinics is within an hour to an hour and a half drive.
Okay.
Well, the other 2 locations within South Carolina that I would want to scale to are Myrtle Beach and Hilton Head, which are more than an hour and a half. It's like 2.5 to 3 hours. So it's not an easy just trip during the day and go come back. And so,
are you driving to these fairly often?
That back then, yes. Like right now, I'm not. Okay. I'm in a position now, which that's another ending to the story, I guess, is where I am now with these. But I would say the biggest thing for me is the regulation around the medical industry.
Okay, fair enough.
But also the risk involved, because we're sitting here paying providers hundreds of thousands of dollars a year to do treatments. Well, guess who has the highest risk? I do.
Yeah.
And so there's certain things that we have to do documentation wise, and if the insurance companies come back and say, "Oh, you didn't do something right," guess who has to pay that back? Not the provider. I got a right to check for it. And so the highest risk is mine. And so there's a balance of risk versus reward versus, where do I want to really be as far as the distance, and do I want to have to fly somewhere to manage them? And
what about bringing in an operator as a COO, a chief operating officer, and then either licensing or franchising, and have it be that you've got a proven business model, and so the liability would sit with whoever the owner of the franchise, who would be a doctor, was, and then you scale out using other people's money, and then they're basically paying you X%. You're managing everything. Your call center's still handling all that stuff. Would that be something that might work?
Did you want to buy one?
I'd like to be part of the process of the central company selling them.
Yeah, I mean, we definitely have considered that, and I've had some physicians reach out to us about that, but we haven't.
Because it seems like you have a great system, and it just depends on what you want for your life and how it fits, right? But since you said you've gotten to the point now where you don't have to go, right? And I want to hear if there's a process of that or any good takeaways. But unless you just hate money. And you have something else, it seems like it would be something that might be worth considering.
We should definitely consider that conversation.
Yeah, cool. So. Okay, all right, go ahead. How did we get to you not having to go at all?
Yeah, so I guess it was probably about the first part of last year, 2018, the first part of 2018, I was listening to somebody speak, and they were talking about how to become the general in your business. And while he was talking, I was like, well, yeah, I am the general in my business.
Do you remember who it was?
It was Ty Lopez.
Ty Lopez. Okay, cool.
So, and I had never heard of him before. Like, everybody was like, "Oh yeah, his YouTube video and his Lamborghini's in the garage." Yeah. I'm like, I have no clue what you're talking about.
Read books,
so
knowledge.
I actually run a business. I don't play online.
Right. Well, that's actually good, because there's good to be learned from everybody, right? No matter what you think of.
That's right. And of course, I went into it blind, because I don't know who he is. I'm just listening to him, and he sounded really good and solid. And,
sure.
So anyway, so he was talking about becoming the general in your business, and I remember sitting back and thinking that I was the general, and then he started to talk further, and I realized that I wasn't. I was just going into the office, putting out fires, and I needed to figure out a way to become the general in my business. The Warren Buffett model.
Right.
And so that night, it was a Friday night at a conference. So that Friday night, I sat in the hotel room till like 2 or 3 o'clock in the morning. I had a friend of mine with me. We were talking till 2 or 3 o'clock in the morning, and it just hit me. I was like, why don't I just promote the guy who's been helping me build this thing? He take him from the COO position and put him into the CEO position. I can step out. I can still own it 100%. I can still be the president and still have my vision, but then I can not have to be out worried about it anymore.
So everything's the same, except I don't have to work in the business.
That was the aha moment,
Nice. That's great. Well, that was a huge takeaway. I mean, you should send him a box of candy or something.
I've been to his house. So.
Yeah. Okay. Nice.
But anyway, so that Monday morning after that event, I sat down with my COO and told him that, hey, I want to leave. And first thing everybody always asks is, are you sick? Are you dying? I'm like, well, I am dying. Everybody's dying.
Are we still going to have our jobs? That's what they want to know.
I'm not, going in for surgery, or I don't have cancer, or that I know of.
I mean, eventually I'm going to die.
Eventually, yeah. So he goes, well, I'm pretty much doing everything as it is anyways, so it's fine with me. And I'm like, okay. So I turned over the few things that I was doing, and basically the next day on Tuesday, that Tuesday, I made an announcement to my team via a workplace live video. That's the software you use to be able to announce it. And so he just made the announcement, and I have maybe been into the clinic maybe 6 times since I left.
Since 2018?
Since the beginning of last year, yeah.
Okay, that's pretty great.
So it's been cool.
Yeah.
So
nice.
But for a week and a half, after I left, I sat back and I was just like doing nothing. Like I basically said I
I was gonna say,
retired.
did you
at
miss
35.
it? Did you find there was like a void?
It was so boring.
Yeah.
I was so. I mean, 'cause I feel like we're born and we're created as producers, and I wasn't producing.
But you still have your shop anatomic.
I still have that.
Okay. And are you not doing anything with that at this
No.
point? So you have another operator that's there.
Yep.
Okay.
Yep.
Great.
So everything right now. So
Time to start a new business.
Exactly. So of course my wife is like, you got to get out of the house. You got to go do something. You're driving me nuts. And so
It just drives you crazy when you're a productive person. You can't not produce. So that, but it's really cool. So you end up with 2 businesses now under your belt that you don't have to do anything with, and time to do number 3. So what was it?
And there were a couple other businesses at the same time too, but we won't get into those. But anyway, so what I told my wife is I said, what I'm going to do in order to figure out what I want to do, because I'd already accomplished a lot up to this point. I said, I don't want to do anything small. I want to go big. Like I had listed out like 20 different opportunities that I could do. And I was like, none of them were big enough. I wanted it to be something
really
that was
cool.
big.
What did big mean to you?
I didn't know.
Okay.
I didn't know what it was. I just knew when I found it, I would know what it was, but I didn't know what it was. And so I told my wife, I said, so I'm out of the house. I'm just going to call up anybody and everybody that I know and just say, hey, I want to go to lunch. I want to go have a cup of coffee. I want to go pick your brain and figure out how I could add value to you.
Pretty smart.
And that will get my creative juices flowing. And I actually went to lunch with a banker in Greenville who had our accounts. They're actually about an hour and a half from where I live, but they've treated us very well. So we stay with them. And I went to lunch with her, and she was like, well, I thought you had always had this interest in real estate. And I said, that's it. And so I went on a path after that lunch, and the next weekend I was at a conference, and I had already been researching the multifamily, the apartment syndication business for probably a year and a half prior to that. But I never had the time, because I was always in the business. I never had the time to focus on it. So I'd done a lot of research already, and that was the aha moment for me. That's what I needed to do.
Interesting.
And so I started to go into that path. And a lot of people in the beginning will teach you to, start small, go get a little 5-unit or 10-unit. And then I'm like, no, I don't want a job. And that wouldn't be big enough for me.
Right.
And so I went on a path to try to figure out who could I hire as a mentor to be able to help me, who is already where I want to be.
Yeah. It's a really good formula for success.
Yeah. So I did. And I said, I don't care how much it cost me, because I know it's going to pay me back in dividends.
Who'd you find?
It was a gentleman by the name of Joe Fairless.
Okay.
And at the time he had just under $500 million in his portfolio.
Okay.
And
is he a teacher, like a course kind of guy, or is just a guy you found?
So he's very exclusive. So he's the type of person. So he actually has the longest running daily real estate podcast.
Okay.
It's called The Best Ever Real Estate Investing Advice Ever.
Wow. Okay.
The Best Real Estate Investing Advice Ever podcast.
Okay.
And it's been going daily for like 5 years. So
Wow.
it's like ridiculous. Kind of like Johnny Lee Dumas did it for how many years he did it.
Yeah.
And so anyway, so he's got a lot of success from that, but he only accepts 2 clients a month. And you had to apply, and you have to have had some form of success in your background, because he didn't want to just waste his time with people that weren't serious.
Right.
And that didn't want to pay the money and whatever. And
how much does he charge?
At that time he was charging $18,000.
Okay.
And of course, to me, I was like, that's actually pretty cheap, because I already priced out a couple other mentors, and they were like twice that.
Right.
Well, and I told him, I said, after I wrote the check and been paid him, I said, you need to probably double your fee.
Double your price.
That's what he's charging now. He's charging $40,000 now.
Is he? Okay.
So
and
now,
worth it. It sounds like
it
right?
is. It's totally worth it. And he has helped me get to where I am right now. We did a little over 130 million in acquisitions last year, and then we're going to do another 125 million this year. But I wouldn't have been able to get to that level of scale without the prior background in the prior businesses. And the reason why I really thought that the real estate was going to be a big thing for me was from the tax side of things, because we were already making a lot of money off of the business, off of the practices and off the other businesses. And I was writing large checks to the government, and I was tired of doing it. And of course, you hear people like Trump paying 0 taxes, and he's a billionaire, and all this kind of stuff. And I'm like, well, what is he doing? And of course, real estate is really where a lot of the advantages are, because of all the depreciation.
Sure.
So we're investing money into these properties, and we're taking depreciation, and it's allowing us to offset our other income. And it's all legal, which is the crazy thing, right?
So you'll have close to $250 million of real estate under management.
Correct.
How does that work? Give us the crash course, the Joe Fearless in 5 seconds or 5 minutes course. How about that?
Sure. So the way we structure it is somebody who say they have some money saving aside. A lot of times we're working with a lot of professionals like doctors, lawyers, dentists. We're working with a lot of actually we have a few chiropractors, not very many, but we have a few chiropractors in there, and also entrepreneurs and people who have money but they're tied to their business or they're tied to their job and they might like that. Like they don't really care to quit that. They want to stay that, but they don't want to, they have this fear of missing out.
Right.
And they want to invest, but they don't want to go and do flipping of houses or single family and things like that. And so they want to have more safety and security in multifamily. Well, multifamily, the reason why it's such a great asset class is because if you look back in the crash in 2008, most asset classes around the average default rate was about 4%. Well, in multifamily, it had one of the lowest at 0.4%. And it's because in a down economy, people can't buy houses. So what do they do?
Yeah.
They rent.
Right.
And the other thing that I really, really like about multifamily, and this is what I tell people when our investors that call and they'll say, well, why should I, invest my money with you? I've spent some time building up my IRA or my 401k, and I'm not going to self-direct it to be able to invest in your property. Why should I invest with you? And I always tell them, I say, well, for one, you have to have somebody on the team with these properties that knows how to run a business.
Right.
Because when you're talking about buying an apartment complex, you're not just buying real estate.
Yeah, it's a business.
You're buying a business.
Sure.
And unless you think of it that way, it's not going to work out.
Right.
Like the nice thing about buying those businesses is that you have the depreciative benefits. So you're spending money or investing money, but then you're also getting this depreciation. And that depreciation comes in the form of doing cost segregation on the properties and things like that allows you to accelerate the depreciation. And of course, with Trump's new tax law, he changed some things that allowed us to get to 100% depreciate and expense all the renovations on most of the items the first year.
Yeah.
And so all that stuff is just major benefits. And depending on your tax classification and things like that, it can offset other types of income that you have.
Sure.
So it reduces your taxable liability.
Okay.
And so we're able to provide returns for investors anywhere between 15 to 18% on a internal rate of return type basis, but more of what most people probably are familiar with as an annualized return or your ROI. So normally anywhere between about a 18 to 22 to 23% annualized return,
and that's for your investors.
Correct.
How about for you?
So we typically structure our deals with what's called a 70-30 split.
Okay.
So we'll find the deal, we'll vet the deal, and we'll put it all together, and we get 30% for our sweat equity.
30% of the profits.
30% of the
ownership.
It's basically 30% of the borrower entity.
So give me an example. So let's say that you find $1 million building, and you want to, let's say a $10 million building so that we get into closer into your range, right? $10 million building, and you put together how much money? Do you put together $10 million or enough to finance it, or how do you do that?
So we do use debt.
Okay.
And so we do what's called permanent agency debt using Fannie Mae and Freddie Mac.
Okay.
And what's really cool about these properties is that they actually allow you to have non-recourse debt on it. And very few assets are like that, but because of how stable it is, the Fannie Mae and Freddie Mac do not require any type of recourse.
Okay.
Meaning that you still have to have somebody on the team that has the net worth and liquidity. So there's three things you have to have when you're acquiring these properties, these types of large loans. You have to have net worth of the loan balance. You have to have liquidity, which is 10% of the loan balance. And then you also have to have experience managing these types of assets.
Interesting. Okay, so $10 million building, what amount do you have to put down?
So just keep the math simple. Let's just say we had to put $4,000 down, okay? Because it's usually about 70 to 75% loan to value.
Okay.
And so when you add on closing costs and things like that, it's going to be, let's just say $4 million.
Okay, so 40% down roughly you have to come out. So now you need to raise $4 million.
Correct.
Okay, so what happens next?
So we have our database of investors. So people who go to our website and they register and say, hey, I want to be one of your investors, and they'll jump on a phone call with me. I'll vet them, make sure they're the right fit, because there's some investors that we don't want to work with.
Right.
And so we don't accept everybody, but if we want to work with them and they seem like a good fit, then we'll put them on our investor database.
Who do you not want?
Well, I would say it's somebody who doesn't trust us.
Okay. Well, how do you find out?
You can
do you
tell
do like a trust fall? Fall backwards and we'll catch you.
It's somebody, I would probably say most of the investors. Well, there's two ways. So these types of these are what they're called securities. So we have to register every single one of these assets with the SEC.
Okay. Is that like a Form D filing or
correct?
Okay.
Yep. And each one of these assets are they're actually. Ask your question one more time.
So I'm looking at the question there was, how do you decide who you don't want to work with?
Okay, so there's two types of investors that we don't want.
Okay.
So number one, you have to realize that because these are securities, they are actually non-marketable securities. So you can't just go to the stock market and you would normally go and just buy and sell shares. It's like you put in 50,000, you put in 100,000. It's locked up for 5 years.
Illiquid, yes.
It's illiquid. You cannot touch it. So you're still getting a return off of that because we're only buying stabilized cash flowing assets. But the second type of investor is somebody who maybe gets onto our database and they start to review our deals, and then they start to piecemeal everything apart, and they try to find as many holes as possible in everything that we're doing. And there's just like we talked about earlier about contracts. You know who I'm talking about.
Yeah.
And you just have to sit there and say
high maintenance.
They're high maintenance, and I don't not that any of that's bad. It's just I don't need it.
You don't need it, and it takes your time. So it creates inefficiencies in how you operate. Plus, it's just not pleasant, right?
And I had an investor just recently that did that.
So nitpickers.
Right. And I basically told him, I said, I don't think that you're a good fit for us because you have great questions, but the way your questions are leading, it shows me that you don't trust us.
Right.
And if you don't trust us, then you need to sit on the sidelines for this one.
Yeah.
And he finally came and just said, no, I still want to invest,
And did you say no?
We'd actually let him in.
Okay.
So we'll see how this one goes.
Okay.
But but sometimes, yes, we're selling investments, if you will, but when you're selling, a lot of times that pushback approach makes people want to get in more.
Yeah, for sure.
And but he knows up front that I'm like, listen, these are great questions, but
you're respectful to him. You're just like, this just isn't. It's not a fit.
Yeah.
We're looking more for.
And I think that this guy will probably invest more and more with us because I know what we do and I know how we're set up and I know that we're trustworthy.
You do what you say.
We do what we say.
Shocking. They'll come back, right?
But he was trying to find things in the contract that wasn't there and trying to say, well, if that's what you're going to do, why isn't it on the contract? It's like, well, because we can't think of everything in the contract,
right?
So those are the kind of people.
So that's one class, the nitpicker. Yeah. What's the other class?
Well, the other class is the one that can't put their money in and not expect to get it out when they want to get it out.
Oh, okay.
So that's somebody who doesn't want to invest.
That's just not a fit.
It's just not a fit.
Yeah.
So those are really kind of the only two. I mean, I always like to educate our investors as much as possible. So on our website, we try to put a lot of educational stuff out there, and I even have an educational arm to our business called Multifamily Investor Nation.
Nice.
Got over 9,000 members of that, and we're educating, doing weekly webinars around the whole topic and various things like that too.
So you vet these people out that are not good investors, and now you've got $4 million you need to raise to buy this $10 million property. That's done through syndication. Is it accredited and non-accredited investors?
So it depends on the project.
Okay.
So some projects it's going to be a registration C, a 506C, and so we can only accept accredited investors in those. But most of ours, I'd probably say 80% of them are going to be still under regulation D, but it's going to be a 506 B as in Bravo, and so those ones we can accept accredited and non-accredited, but they still have to be sophisticated.
Okay, great. So now, and then you've got how do you find these investors?
Doing podcasts like this are a lot of times where we find our investors. And I had one just recently that was on a podcast, and he actually lives 10 minutes from my house and said, I heard you on a podcast and I want to come in and be a part of this.
Nice.
And he's invested in two of our projects now to the tune of about $500,000 with just that one investor.
Is it mostly organic like that, or do you use paid media as well?
It's all been organic.
All organic.
All
okay.
organic.
So do you know Ron LeGrand? Do you know
I do.
Okay. He always used to say, just flapping your lips. You just make it flapping your lips.
Yeah.
So it's like,
yeah.
It's
well,
funny. You just talk.
There's a lot of different ways that we find them. I mean, one of the biggest things is doing the podcast, but also educating in the space, because a lot of people are wanting to do it themselves, and so they go find the education, and they realize that it actually is a lot of work,
right?
Which is why you get the sponsor or the operator gets that 30%, because it is a lot of work.
Okay. So when the when the deal is done, you're in now. We've got a $10 million acquisition. You've come up with the $4 million. You're ready to invest. You get your Fannie Freddie financing, and you acquire the property. Who owns the property?
So the borrower entity owns the property. So that borrower entity is owned 70% by the Class A investors. Then you have Class B investors or B shares, which is the operator who owns the other 30%.
Okay.
And so those are a 70-30 split like that.
Is there any protection for them? So because what I would be thinking would be, and you can tell me I'm not a fit if I'm not. You can. What I'd be thinking would be, okay, if that $4 million now is the down, so we have equity of $4 million in the property and $6 million of debt at fair value, assuming we didn't buy it for a whiz bang amazing price. Then the $4 million, I am now $1.2 million. 30% of the $4 million has gone over to the entity that you operate, and our entity has taken a 30% hit in value. I'm not saying that's bad. I'm just saying that's how.
It's not how it's structured, though.
Okay, tell me how it's structured.
So it's actually it's a 70-30 split, but you have to pay back all the initial equity first before that 70-30 split.
Great. Okay, so they get all their money back.
Correct.
Is there any interest that accrues on the money as well, or?
Yes. So there's we structured them with a 70-30 split with an 8% preferred return.
That's pretty awesome. So no worst case, unless it loses money, all of their money plus an 8% return annualized over the 5-year period. You do them for 5 years?
Correct. And it's actually what's called a cumulative preferred return. So if one year we hit 6, so it's going to be 8, it's going to be 10 the next year.
Yeah.
So
got it. Okay. Cool. Okay. So they're good. They're not losing any money. Now you've got the deal. You go in. Now what do you do? What does your company do?
Yes, so that's when we take over. So really, I would say a lot of it happens in the beginning, and a majority of it happens at the end.
Okay.
There is a lot going on in the middle, but we actually use a third-party property management company to do all of our property management. And so every week, one of our team members is on a call with each one of our property managers to make sure that we're hitting the goals and the targets and it's going the way we want it to.
Okay.
Because every one of the assets that we're buying, we're doing a value-add play. So we're doing some form of interior renovations, exterior
Is that built
upfits.
into the raise as well?
It's all built in.
Yeah. Okay.
So that's why $10 million, you have to add on to it the renovation costs and things like that.
So it's roughly 25% down and then 15% in
Correct.
in what is it? Rehabilitative.
CapEx.
Yeah, CapEx. There you go. That's it. That's the word I was looking for. And so now then, are the property managers third parties or are they people that work for you?
They're all third party.
Okay, so you go to third party management company that's got good track record and all that kind of stuff. Vet them out.
And the lenders have to vet them too.
Right. Okay. Great. And then what happens after 5 years? I want my money back and the property hasn't sold yet.
So there's two things that happen. So either the investor wants to do a 1031 exchange with us and we go into the next property.
Yep.
Or they can opt to get out of it as well.
Okay. And if somebody opts out, but it's a bad time to sell, what do you do?
We hold on to it. So the projections are 5 years. Okay. And so, but based on our operating agreement, we tell our investors that you obviously know that our goal is to protect your investment.
Right.
So if in 5 years the economy is not doing well enough for us to exit, we'll hold on for the next 2 or 3 years if we need to.
Okay.
So we're going to wait until we actually can sell at the right time.
And you could always, I'm guessing, offer to buy them out individually for whatever the promised return was. Right?
Sure.
So if they were like,
it's
I
just
really
not
need the money,
guaranteed.
and you're like, yeah, dude, I got you. I got somebody. I'll bring them and swap you out.
That's what we tell our investors is that it's not guaranteed. So based on if you read the actual PPM disclosures from what we have to give to our investors, it says that there is no guarantee for that.
Right.
But
we will certainly try.
When we have 100 investors on a deal, what's the chance of that one of those investors could buy out another investor if they lost, if they were in the hospital for 6 months and needed the money?
It's pretty good.
Someone's going to find it.
Right.
So
okay, fantastic. And so if somebody was interested in finding out more about all of that stuff, what would the best way for them to find out more be?
So the first step is to go to passiveinvesting.com. You can find some more about some of the other properties that we've already acquired there. There's a whole list of them there, but there's also some strategy stuff there and why apartments are good and things like that.
Nice.
And then on the website there's a form. It's an investor form. They can fill that out. And then my assistant will actually reach out to them and schedule them on my calendar, and we'll have a conversation and make sure they're a good fit.
Okay.
And then we can put them on the list for the future opportunities. And we usually have about 1 to 2 opportunities a quarter that we're putting together.
Nice.
And then the next one that comes available, they can review it and kind of go from there.
And are you talking to these investors?
I am.
Okay. So when are you going to outsource that?
Well, right now I'm very strategic with my time, so I only schedule them right now on Tuesdays.
Okay.
And Thursdays if I have to, and if they can't fit there, then we'll usually have my assistant has access to my whole calendar, so she'll put them wherever she needs to.
Yeah.
But there will be a certain point in time where we will have to do that.
What's the plan? What's the end game?
Well, right now our goal with that company is to get to $1 billion of assets under management.
Absolutely makes sense.
So my mentor is almost there. So he's about 700 or 800 million right now.
Nice.
And we're on our way to get there as well. And we haven't really put a full thought process behind exactly what we're going to do once we get there, except for the fact that we're going to consider private equity play.
Yeah. Are they 30-year notes? That what's the funding?
Yeah. So it's a 30-year note with a 10-year balloon. And then we get some phenomenal debt. So we actually are structuring one right now where we're getting 5 years of interest only, 3.8% interest.
Yeah, that's nice.
10-year note on a 30-year AM.
Sweet. Very cool. Awesome. So other ways, that's how to get a hold of you for real estate. If they want to buy anatomical products, it's shopanatomical.com.
Shop Anatomical.
And if they want to get their back fixed from a non-surgical, non-chiropractic clinic, where would they go for that?
That's Vitality Medical Centers.
VitalityMedicalCenters.com.
It's actually VitalityMedCenters.com.
VitalityMedCenters.com. And if they wanted to get a hold of you personally, are you on the socials? Do you have an email you want to give? What's the best way for them to do that?
They can shoot me an email if they want. It's just Dan@passiveinvesting.com.
Awesome. Thank you. Thank you so much for being on the show. I really appreciate it.
Thanks for having me, Roland.
Awesome.